Okay, let's dive right into this. Welcome back to The Explainer. Today we're looking at an absolute masterclass in corporate evolution. We are going to explore the complete juggernaut that Netflix has become by the year 2026. We're breaking down exactly how they transformed their business model, completely rewrote the rules of digital entertainment, and basically secured a near untouchable position in the streaming wars.
But before we even get into the weeds, you really have to ask yourself, how does a company justify a $20 billion content budget for a single year? Just let that number sink in for a second. That's what Netflix is forecasted to spend on content in 2026 alone. Literally an all-time record for a single buyer of entertainment. From the outside, dropping $20 billion on movies, TV shows, and live events sounds like total financial recklessness. So how does the math possibly work?
Well, here's your answer. 325 million. That was their global paid subscriber base by the end of 2025. This mind-blowing scale is the entire foundation of their business model. When you're programming for a global audience of this sheer magnitude, a $20 billion check isn't a gamble at all. It's a carefully calculated investment spread out over hundreds of millions of paying households.
So how exactly did they build a machine capable of sustaining this? In today's Explainer, we're going to deconstruct the structural pillars that make this entertainment juggernaut so dominant today. We'll start with their unmatched audience scale, move into the billion-dollar content engine, examine how they unlocked massive new revenue with ads and password crackdowns, look at their bold pivot to live sports, and finally break down their new profitability playbook.
Starting with part 1, the global streaming giant and their totally unmatched audience scale. Before we can truly understand the content they're making, we really have to understand the sheer size and the specific behavior of the audience that's watching it. Now, what's incredibly interesting about this data is how incredibly tight the US streaming race actually is. If you look at the US subscription video on-demand market share, Amazon Prime Video is sitting at 22%, with Netflix right on its heels at 21%. They're both miles ahead of competitors like Max, Disney+, and Hulu. But here's the catch. The United States market, while obviously highly lucrative, is heavily saturated.
So the real growth story, the actual engine driving that 325 million subscriber count, is international. The US is naturally their biggest market with over 81 million subscribers. But actually, notice the bottom of the data here. Brazil now officially matches Germany with 16.59 million subscribers. This is a massive testament to Netflix's really aggressive Latin American expansion and their strategy of investing heavily in local content production just to win over these global regions.
And they aren't just getting people to sign up, they are absolutely dominating their daily attention. 63 minutes. That's the average amount of time a user spends on Netflix every single day. To put that into perspective, they are crushing major social media competitors in the battle for screen time. TikTok users average about 54 minutes, Instagram users around 35 minutes. Netflix isn't just a streaming service anymore, it's a daily habit that commands over an hour of uninterrupted attention.
Which brings us to part 2. The billion-dollar content engine, fueling the binge.
So what exactly are 325 million people watching for 63 minutes every day? Well, historically, Netflix was just a storefront for other studios' movies and TV shows. But today, it's a near even split. Basically, 46.5% of their budget goes to exclusive Netflix originals compared to 53.5% on licensed content. When legacy studios like Disney and NBC Universal started pulling popular shows like The Office and Friends to build their own platforms, Netflix didn't panic. They just evolved into the largest single commissioner of exclusive original entertainment in history.
And making that evolution reality required a nearly unbroken 928% upward trajectory in spending. They started at $1.75 billion back in 2012. And notice that the only 2 drops in their entire spending history were forced by massive external global shocks. You have the 2020 global pandemic, which halted production, and the 2023 dual Hollywood strikes. But look at that rebound. They hit an all-time record of $18 billion in 2025, with a massive $20 billion guided for 2026.
I really love this quote from the research because it perfectly summarizes the sheer brilliance of their content moat. Today, Netflix possesses a library of over 1,000 exclusive original titles across all genres. It's a library that simply cannot be replicated anywhere else, and they own it indefinitely. That is exactly how they keep those 325 million subscribers locked in.
Let's move on to part 3. Ads and password crackdowns and how they unlocked new revenue. So here's the big question. How does a company continue to grow its revenue when seemingly everyone already has an account? Well, for years, Netflix kind of turned a blind eye to account sharing. But when they realized over 100 million households were sharing passwords, they made a massive, highly scrutinized gamble to force users to actually pay for their own accounts. And the data shows it paid off brilliantly. Post-crackdown, they saw a staggering 102% increase in U.S. daily signups, adding over 9.3 million new subscribers in just the first quarter of 2024. They basically took millions of unauthorized viewers and moved them directly onto the balance sheet.
And right alongside that crackdown, they introduced a cheaper ad-supported tier. By May 2026, the monthly active viewers on this ad-supported tier reached an astonishing 250 million. They essentially created a perfectly timed landing pad for price-sensitive consumers who might have been pretty frustrated by that password crackdown.
And this brilliantly illustrates exactly why this dual strategy works so well. Almost half of all new signups are now choosing the ad tier. It's a massive win-win for Netflix. They lower the barrier to entry for the consumer while simultaneously creating a highly lucrative new revenue stream. In fact, ad revenue is projected to double to around $3 billion by 2025. They essentially built a massive digital advertising network overnight.
Let's move to part 4 and see how this builds into their next frontier, the live sports pivot. Because Netflix isn't just an on-demand library anymore. If you want to know why their 2026 content budget spiked to $20 billion, look no further than these specific live event investments. They signed a staggering $5 billion 10-year exclusive deal for WWE Raw. They secured exclusive rights to NFL Christmas Day games, and their boxing event featuring Jake Paul and Mike Tyson pulled in over 60 million viewers. They are buying the biggest, most spectacle-driven live content on Earth. Now, why does this pivot actually matter? Well, because while binge-watching original series is great, weekly live sports create massive, predictable, and simultaneous spikes in viewership. It turns Netflix from something you watch when you have free time into something you absolutely must tune into on Monday night at 8 p.m. It drastically reduces subscriber churn, and more importantly, advertisers are eager to pay an absolute premium to be in front of that captive live audience. Finally, let's wrap up with part 5. The new profitability playbook, moving from burning cash to record margins.
So the crucial point here is, does this incredibly expensive multi-tiered strategy actually turn a profit? Yes. This is the structural financial flip that analysts absolutely love. Back in 2016, Netflix was spending 78% of its total revenue just on content. They were burning cash to build out their library. But by 2024, because their revenue grew so massively, that $16 billion content spend only represented 41% of their revenue. And by 2026, even with a massive $20 billion budget, it's projected to drop to just 39% of their $51.2 billion in revenue. Their revenue is finally growing much, much faster than their content costs. And Wall Street has absolutely rewarded this incredible financial efficiency. When you look at their massive valuation growth, driving its market cap past $417 billion, it's just wild. This incredible growth officially makes Netflix the 26th most valuable company globally. They aren't just a tech stock anymore. They're a highly profitable blue-chip media powerhouse.
When we break down the microeconomics by region, we can see exactly where that revenue power comes from. While international growth in Asia-Pacific and Latin America is absolutely crucial for subscriber volume, the North American consumer is still their most lucrative asset by far. The average revenue per user in the US and Canada sits at over $17 a month. This blend of high-margin legacy users and new, fast-growing international regions creates an incredibly resilient global balance sheet, which all leads us to this incredibly powerful financial reality. In 2024, despite dropping $16 billion on content, Netflix walked away with $8.7 billion in pure net profit. When you have a paying base of 325 million subscribers, you can afford to be the biggest spender in the room and still generate record margins.
Netflix is completely transformed from a DVD mailer into a platform that owns its own original content, commands an hour of daily attention from hundreds of millions of people, monetizes viewers through dual subscription and ad models, and is now taking over live sports. So I'm going to leave you with this final thought to ponder. With this multi-billion-dollar engine firing on all cylinders, how can traditional media, or really any streaming rival for that matter, possibly dismantle this carefully constructed juggernaut? Thanks for joining me on The Explainer, and I'll see you next time.